Warren Buffett's $10,000 ETF secret. Warren Buffett has been consistently pointing to the same ETF, indicating a potential investment opportunity. This ETF could provide a significant return on investment, making it an attractive option for those looking to diversify their portfolios. But what's driving its performance? And that ETF is the Vanguard 500 Index Fund, with over $700 billion in assets under management. It's had a 10-year average annual return of 13.6%, outperforming the S&P 500 by 1.2% annually. For example, if you invested $10,000 in this ETF 10 years ago, you'd have around $33,000 today. But the real question is, what's driving its performance? The answer lies in its diversified portfolio of 500 stocks, including Apple, Microsoft, and Amazon. So, let's take a closer look at the numbers. The ETF has a low expense ratio of 0.04%, which is significantly lower than the average expense ratio of actively managed funds. This means you get to keep more of your returns. But some might argue that this ETF is too big, and its size could hinder its performance. However, historical data shows that the fund has consistently outperformed its benchmarks, even with its large size. For instance, back in 2019, the ETF returned 31.5%, while the S&P 500 returned 30.4%. Additionally, the ETF's dividend yield is around 2%, providing a steady stream of income for investors. Now, let's move on to the next section, where we'll explore how to invest in this ETF. But how do you actually invest in this ETF? It's relatively straightforward. You can buy shares of the ETF through a brokerage account, such as Fidelity or Vanguard. The minimum investment is $3,000, and you can set up a monthly investment plan to invest as little as $100 per month. For example, if you invest $100 per month for 10 years, you'll have around $24,000, assuming a 7% annual return. And if you're concerned about the ETF's performance during market downturns, historical data shows that it has consistently recovered from past recessions. Back in 2008, during the financial crisis, the ETF's value dropped by around 38%, but it rebounded by over 26% in the following year. Furthermore, a common misconception is that you need to be a seasoned investor to invest in this ETF. However, with a low expense ratio and a diversified portfolio, it's an attractive option for beginners and experienced investors alike. For instance, if you invested $5,000 in this ETF and let it grow for 15 years, you could potentially have over $20,000, assuming an 8% annual return. So, what's the best way to invest in this ETF? The answer is, it depends on your individual financial goals and risk tolerance. But one thing is clear, investing in this ETF could be a smart move for those looking to diversify their portfolios. Now, let's take a break and come back to the next section, where we'll explore the potential risks of investing in this ETF. But the part that surprised me most is what this ETF does to your 401k and how it can help you build wealth over the long term. You'll be amazed at the impact it can have on your retirement savings. For instance, if you invest $5,000 in this ETF and let it grow for 20 years, you could potentially have over $30,000, assuming an 8% annual return. That's a significant boost to your retirement fund. But what's even more interesting is that this ETF can also help you avoid common pitfalls that can derail your retirement plans. We'll dive into the details in the next section and show you how to maximize your retirement savings. And, as with any investment, there are potential risks and considerations. For example, the ETF is heavily invested in the tech sector, which can be volatile. If the tech sector experiences a downturn, the ETF's performance could suffer. Additionally, the ETF has a high concentration of its assets in the top 10 holdings, which can increase its risk. But it's also worth noting that the ETF has a long history of outperforming its benchmarks, even during times of market volatility. So, what's the best way to mitigate these risks? The answer is, it's all about diversification. By investing in a variety of assets, including stocks, bonds, and real estate, you can reduce your risk and increase your potential returns. A common misconception is that diversification means spreading your investments across many different stocks, but it's more about allocating your portfolio across different asset classes. But what's even more surprising is how this ETF could impact your tax bill. and the strategies you can use to minimize your tax liability. We'll explore the tax implications of investing in this ETF and provide you with actionable tips to help you save on taxes. For example, did you know that the ETF's tax efficiency can help you save up to 10% on your tax bill? But that's not all. We'll also show you how to use tax loss harvesting to offset your gains and minimize your tax liability. We'll dive into the details in the next section and show you how to make the most of this tax benefit. So, how does this ETF impact your tax bill? The answer is, it depends on your individual tax situation. But one thing is clear, the ETF's tax efficiency is one of its key benefits. With an average turnover rate of 3.5%, the ETF minimizes its capital gains distributions, which means you get to keep more of your returns. For example, if you're in the 24% tax bracket and you invest $10,000 in this ETF, you could save around $240 in taxes per year, assuming a 7% annual return. Additionally, the ETF's tax efficiency can help you avoid the wash sale rule, which can save you even more in taxes. Back in 2018, the Tax Cuts and Jobs Act introduced new tax laws that affect investment income, and this ETF can help you navigate these changes. But it's also worth noting that tax laws and regulations can change, so it's essential to consult with a tax professional to understand the tax implications of investing in this ETF. Furthermore, the ETF's low expense ratio and diversified portfolio make it an attractive option for investors looking to minimize their tax liability. Now, let's summarize the key takeaways and provide a clear call to action. In conclusion, Warren Buffett's favorite ETF could be a smart investment opportunity for those looking to diversify their portfolios. With its low expense ratio, diversified portfolio, and tax efficiency, it's an attractive option for investors. But, as with any investment, it's essential to understand the potential risks and considerations. To get started, take the first step by opening a brokerage account and investing in this ETF. You can also consult with a financial advisor to determine if this investment is right for you. If this changed how you think about investing, hit subscribe. I break down one of these every week. And, as a special bonus, check out the link in the description to read the Spanish language deep dive on this topic. Additionally, take a moment to review your portfolio and consider how this ETF can help you achieve your long-term financial goals. By taking action today, you can set yourself up for success and build wealth over the long term.